Welcome to the deep dive. We've just been poring over a stack of professional trading desk reports, and the verdict is pretty clear. The market has entered what they're calling an extreme risk-off environment.
That's definitely the dominant narrative this morning. So our mission in this deep dive is to, synthesize all these critical financial signals, everything from the futures markets to what we're seeing in institutional hedging.
To really understand why the pros are so scared right now.
Exactly. We are seeing major systemic weakness, but, and this is crucial, with some key divergences that you really need to be aware of before today's trading begins.
And that immediate tone is just undeniably bearish. I mean, looking at the U.S. equity index futures retreating overnight, it's a classic flight to quality trade playing out.
It is. The defensive Dow is holding up relatively well, while the small cap Russell is getting hammered.
That divergence alone is a huge signal, isn't it?
It's a massive one.
Okay, so let's unpack the scale of this retreat.
Yeah.
When we talk about extreme risk-off, which sectors are really shouldering the biggest burden here?
Well, the burden is falling squarely on the areas of the market we'd consider the highest risk. So, high beta stocks and small caps.
Right.
Just think of the small cap index, the RTY, as the market's main risk thermometer. Overnight, it dropped significantly. We're talking a loss of negative 1.6%.
Wow. And the tech-heavy NASDAQ.
The NQ followed pretty closely, retreating by about 1.4%.
That RTY number, the small caps, that always confirms institutional de-risking. They sell the riskiest assets first.
Exactly. And you contrast that with the blue chip Dow, the YM, which only retreated by about 0.8%. That disparity tells you everything. Institutions are prioritizing defense.
And technically speaking.
Technically, all the major indices are starting the day trading below their overnight point of control.
Okay, for our listeners, can you just break down point of control in simple terms?
Sure. It's just the price level where the most volume, the most contracts, traded hands overnight.
Yeah.
And if we're trading below that level...
It means most people who got in are already losing money.
Precisely. It locks in an immediately bearish technical outlook. For the S&P 500 futures, if this weakness persists, the immediate support is that big psychological level of 6,600.
And if that breaks...
If that breaks decisively, it really opens the door to the next critical institutional level, which is down at 6,477.
So the big ships are sinking, but if you look closer at the smaller boats, we're seeing some unexpected upside momentum. This is where it gets really interesting for me.
Yeah, this decoupled flow.
Exactly. What's driving this simultaneous surge in some specific names?
We're seeing these really focused, idiosyncratic flows that are just defying the index sell-off. For example, you have OMERS Corp, OMER, which surged over 15%.
15%.
On sector-specific news, a biotech rotation. Then there was Dragonfly Energy, DFLI, with huge volume after they announced a $13 million Q4 revenue target.
And Jazz Pharmaceuticals was another one, right?
Yes, JZZ is up following better than expected earnings.
That's fascinating. So these gains are all driven by company-specific catalysts, not broad market optimism.
That's exactly. It's a real tug-of-war between strong individual corporate news and just massive macro fear. While the indices are screaming systemic weakness, these specific stocks are, for now, overcoming that negativity.
So traders need to realize that these pockets of strength are kind of masking the severity of the index de-risking.
Yes, very much so.
Okay, we've confirmed the panic in the indices, but how deep is the conviction behind that selling? Let's dive into the market internals from yesterday. What are the quantitative indicators telling us about the health of this sell-off?
The health is concerning, and the conviction was definitely high. The market is really operating with a split personality, and you can see this perfectly in the quantitative signals.
Where do we start?
First, the TRN, or the ARMS index. It closed at 1.23. This is a definitive bearish reading. It confirms that selling pressure was conviction-driven.
Meaning heavy volume was in the declining stocks.
Heavy volume, concentrated in declining stocks, but, and here's the first twist, the sources also cite this level as approaching short-term oversold conditions. So that hints we might be due for a technical bounce just from selling exhaustion.
So the selling was real, but maybe the sellers are running out of steam for a moment. Now, where does that split personality show up most clearly?
In the put-call ratios.
Yeah.
The PCR. This is the key insight today. It's like seeing all the experts buying life insurance right before they predict a storm, while the general public is still, planning a beach picnic.
Okay, break that down for us.
Well, the equity PCR that tracks individual stock options, it closed low at 0.76. This signals complacency.
That's the retail crowd.
That's the retail traders. They're still favoring calls or using puts sparingly. They just don't seem scared.
And the professionals.
Well, you contrast that with the SPX Index Volume PCR, which tracks hedging on the entire S&P 500. That thing spiked to 1.26.
1.26, that's high.
Very high. Anything over 1.2 is a strong institutional fear signal. It means the big professional desks are aggressively buying index puts to hedge their portfolios against a systemic collapse.
So the public is complacent about their individual stocks, but the pros are buying disaster insurance for the whole market.
That is the implication. And this divergence makes the market extremely vulnerable. The bias has to remain defensive until that index PCR normalizes, because if that retail confidence finally breaks...
It could trigger a much, much steeper decline.
Exactly.
This kind of systemic move rarely happens in a vacuum. If we connect this to the bigger picture, how did global markets and commodities react? What does that tell us about the underlying cause of all this fear?
The sentiment is globally pronounced. It's a deep risk-off sentiment. Asian markets were hit hard. Japan's Nikkei 225 slumped a significant 3.2%.
3.2, that's a big move.
It is. And the German DAX dropped 1.2%. So this confirms the selling is a global macro event, not just a U.S. issue.
And when everyone gets scared, capital has to flow somewhere safe. So where's it going?
It's flowing to the dollar. Dollar strength is the primary theme here. The U.S. dollar index, the DXY, is near a one-month high. We're seeing classic safe haven dynamic.
Okay, let's talk commodities, because that often gives us the clearest read on real physical economic demand.
This is a massive signal. WTI crude oil is now trading below $60 per barrel. It's broken that key psychological and technical level.
And crude breaking 60 isn't just a number, is it?
No, it's a flashing red light on global industrial health. Traders are essentially betting that we're going to need less oil because they anticipate a sharp reduction in global demand, a material economic slowdown.
And that ties directly into fixed income, where investors run for safety.
Precisely. The U.S. 10-year Treasury yield ticked lower. And that simultaneous move falling global stocks, falling crude oil, and a falling 10-year yield, it just confirms a strong flight to safety bid for bonds.
When yields fall as stocks fall, it confirms the market is pricing in real growth risk.
That's the textbook definition of it.
That macroeconomic diagnosis is certainly sobering. The market is, of course, looking ahead. What high-leverage data and key corporate reports are said to inject some volatility into this already nervous environment today?
We have a major volatility event on the calendar. The U.S. Industrial Production and Capacity Utilization Report. That's at 14:15 UTC. The market consensus for capacity utilization is around 78.2%.
And this number is a primary input for the Fed.
A primary input. Historically, a reading above 80% is associated with rising inflationary pressure.
So if the number comes in hot, say above 80, the fear shifts from recession to inflation and rate hikes. And if it misses significantly,
then the recession thesis we just discussed gets validated, which could accelerate that flight to safety and confirm what we're seeing in crude oil. It's a huge pivot point for the day.
And the biggest corporate bellwether report.
That's Home Depot HD reporting pre-market. Consensus EPS is really tight, but HD acts as the definitive bellwether for the health of the U.S. consumer and the housing market.
Two absolute critical sectors.
Critical. So traders will be dissecting their comparable store sales, looking for any divergence between the professional contractors and the DIY customers. A weak pro sales number would be a huge deal.
It would confirm that the high-ticket spending market is slowing down, lending serious credence to all this macro fear.
Exactly right. And we can't ignore the European data either. The German ZEW economic sentiment is expected to improve, which will drive some volatility in the Euro-USD pair and feed back into that strong dollar theme.
So given all this, what's the takeaway for the session ahead?
The market is positioned defensively. I think the environment suggests we're moving from outright fear toward a kind of volatile stabilization.
And the technical picture supports that, doesn't it? I mean, the VIX is back below 16, which suggests that selling exhaustion we saw in the Terrain is playing out.
It does. Our primary hypothesis is for choppy technical consolidation with a bias to bounce, but with high data-driven volatility around those key reports.
So what are the levels to watch in the S&P 500?
For bullish confirmation, a signal that the indices are really recovering, we need a decisive break and a hold above 6720. That was a key resistance level.
And what confirms that the bears are still in control?
The bearish invalidation signal would be a decisive break below yesterday's low, 66.45. That move confirms the correction is continuing, and it validates all that systemic fear we tracked overnight.
So, to summarize that for you, we're coming into the session with high institutional fear, that index put-call ratio of 1.26 set against this weird retail complacency. And all eyes are on Home Depot and U.S. capacity utilization to see which side breaks first.
The market is in a highly precarious position. We know that Home Depot's earnings are a key proxy for consumer health. So given the massive institutional hedging we've observed, if HD reports weak pro-customer growth, if it confirms a slowdown in that high-ticket spending market, how quickly might that retail complacency we saw in the equity put-call ratio finally break?
A perfect question to keep top of mind as the day progresses. Thank you for diving deep into these complex sources with us and helping us decode the signals. We hope this analysis helped you stay one step ahead of the flow.